Welcome to case study number 3. In this case study, we're going to look at the different ways in which you can use your company shares to reduce your personal exposure to tax, especially with rates of tax on dividends increasing, and we've still got the opportunity to make use of entrepreneurs relief and a couple of other tax-efficient planning opportunities. The key is to plan ahead, but not to let these valuable statutory planning opportunities to go to waste. We can help entrepreneurs to sell their business and pay 0% in CGT at the moment, or we can show them how to use their £1 million entrepreneurs relief and pay tax at 10% instead of receiving income by way of dividends, which are taxed at a much higher rate. So without further ado, let's have a little look at our example company. Okay, so we have a company, relatively simple and straightforward, called ABC Trading Limited. There's 2 shareholders, there's Mr. Case Study and Mrs. Case Study, and they've each got shares in the business equally. Now, these shares, if you've got eagle eyes, you'll notice at the moment they are 1 share per person. In a lot of situations when you get involved with share planning, it's useful to actually split those down. So instead of having one £1 share, you split them down into 100 1p shares or a higher number. So here we go. Let's have a little look at the company and the 2 shareholders. What else is around that helps us in terms of planning? Well, immediately we've got an issue. We've got 2 adult children, and at the moment they're not involved in the business. So the question is, what is it that we could or should be doing for a company in this situation? Well, it all depends on when we're talking to them. There's different life stages of a business, so let's walk our way through those and see what we come up with. In the early stage of setting up a business, from a technical perspective, the shares could well have a near to zero value, and that's actually a great time to think about what to do with regards to the business and the future value of the shares, because each individual has the entitlement to set up a policy called a QNUPS, qualifying non-UK pension scheme. I say policy, technically speaking they're either trusts or contracts. But you can move shares into a QNUPS, and because they are either at zero value or close to zero value, your issuing of new shares won't cause any tax problems, or your moving of existing shares won't have any tax problems. Now, a QNUPS is a wonderful thing. It's a pension, therefore it pays 0% tax on dividends. The shares that are sat within the QNUPS, if they are ultimately sold, will pay 0% CGT on the sales. And of course, assets held within a QNUPS are exempt from inheritance tax. So they're very useful things, and if you meet a business, or if you are a business who at the early stages, then doing something up front is going to be very beneficial. But we mustn't forget, it's not just about using QNUPs, there's also family involved. So part of our process is always to take a step back and not talk about tax, but actually to talk about the family and the directors and the shareholders and what it is they're trying to achieve and where we can add value. Okay, the next stage in a business life cycle is when it's mid-stage and it has a moderate value, it's trading, and the people who run the business think there's a fair bit more growth within the business value. The first question is, have they achieved the £1 million each, which is the level of entrepreneurs relief, because it'd be quite useful to use that now before it's abolished or changed. We've seen it come down from 10 million to 1 million, so we do have an opportunity to use the entrepreneurs relief now for businesses that have been running for a while and have achieved a moderate value. The first options again involves a QNUPS, and because the shares have achieved a moderate value of £1 million each, what we can't do is just move those shares, because that would trigger an enormous capital gains tax charge immediately. So what we can do is create a new class of shares, and with a bit of clever legal work, those shares can attract all the future value of the shares, which means on the day they're created they actually have a zero value. Now that's very important, because that means that they can be issued straight into a QNUPS, or they can be transferred into a QNUPS if they were issued to the individuals without any major tax issues, purely because they don't have any current value. Again, I'm being fairly glib, it needs to be done properly and professionally. So that's one of the options, but the question we're always asked is, what happens if the business were to be sold at some point after this planning has been put into place? In terms of mid-stage planning and a future sale, we're going to pretend here that this business was sold for £5 million. And the original shares, the value of those at the time was, let's say, £1 million, and those shares will hopefully attract entrepreneurs' relief and be taxed at 10%. The additional shares that were issued into the QNUPs obviously will have no tax to pay because the QNUPs falls outside of the CGT regime. So we have a situation where we've sheltered the bulk of the sale proceeds from being taxed. Another option with a mid-stage planning company is to actually sell the business now. And I don't mean sell it to a competition or to an outside person. What I mean is to actually construct a sale which is completely acceptable to HMRC and actually gets pre-clearance from them. So the first thing is we do need to do this properly. We have a proper valuation, and in this particular case we have a proper valuation of their shares at £1 million each, which is miraculously exactly the level of the entrepreneurs' relief, and they'll be paying 10% tax now on the sale. So let's look at what happens. Their shares are sold, and they're not sold in the marketplace, they're not floated, they're not sold to a completely independent third party. They are actually sold to a special type of corporate trust, which from a legal perspective is and has to be independent and third party. But at the point of sale, that corporate trust doesn't have any money, so it can't pay them their £1 million each. But because the sale has proceeded through to completion, there will be a capital gains tax calculation to be done, and in this case they'll each have to pay capital gains tax on £1 million that at the moment they haven't received. And again, this is the next question when people are selling their business: what happens with regards to tax, and what happens with regards to the money that I'm owed? So we've got a corporate trust containing the shares, and dividends have been declared into the corporate trust. So in year one, we have dividends. In this particular case, let's imagine that's £100,000. If that dividend was paid into the corporate trust, the trust now has £100,000, and it can make a payment to the individual in lieu of the fact that it owes them £1 million. And half of that payment has to go to HMRC to settle the CGT liability, and the other half will come to the individual who is owed the £1 million. So that's year one. They get £50,000 in their pocket, and £50,000 goes to settle part of the capital gains tax liability. Then in year two, you have the same split, 50-50. And this is a theme. If you're paying your CGT in instalments, as long as you pay half of what you've received across towards your debt, in inverted commas, then the Inland Revenue are quite happy with being paid in stages. And in year three, we've reached a situation where actually in this case there is no more CGT to pay, so they receive and get to keep the 100,000. It has effectively been tax paid because the CGT liability has been settled on the £1 million, and from there on, year 4 and 5 and 6 and so for all the following years, they get 100,000 per annum without any further tax. So that was selling their business now at mid-stage, and they've sold it effectively for £1 million each. So what happens if they genuinely do sell the business to a third-party competitor or someone who wants to take the business on? So we're going to look at that next. In this particular case, we're going to imagine a future sale of £5 million in year 3. So they've had their first 2 years, they've paid their CGT, and the corporate trust actually then sells the business for £5 million. So the corporate trust has now got £5 million of cash sat in it, and let's have a look at what happens. Internally, that £5 million is split. 1.6 million is split because that is what's owed to the two shareholders. They've had 2 years worth of 100,000, and there's 1.6 million left to pay them both off, and that leaves 3.4 million still sat within the corporate trust. So the two individuals, Mr. and Mrs. Case Study, they get £800,000 each. They've paid all their tax already. There is no more tax to pay. So that is just settling effectively their capital transaction. The remaining 3.4 million can be invested within the trust structure. I'm not going to go into details of subsidiary companies held within the trust and all of those sorts of things. We're just going to keep it fairly headline-ish at the moment. But the remaining money remains in the trust and can be invested. It can also be used for secured lending, which isn't restricted. It can come to them. And of course, money can be paid to the employees as well. So it becomes an investment vehicle. What if we're meeting someone and they've built up a significant value and they're thinking, well, it's pretty close to being their final value. So same couple, same business. This time they've had a proper valuation and it's up to 18 million. They reckon they might be lucky and they might be able to sell for 20 million in the future. So it's doing well. Things are going very nicely. And the value they have is way too big for them to be able to move their shares without triggering a huge gain. The other thing is that the time frame between now and potentially them selling the business is too short for the corporate trust we mentioned previously to be able to pay them off over an 8 or 10 year period. So let's have a look at this scenario, because there's a special twist here which can be extremely, extremely beneficial, because we can get them to sell for 18 million into a special type of trust, and in this particular case it's called an employee ownership trust, or an EOT, and you may see the jargon dotted around if you do searches on Google, etc. It's a very special type of trust, and little picture of people there, and a 2-to-5 ratio is trying to explain the fact that there needs to be employees in the business. So if you've got a family that owns a company and there's 5 or 6 family members who own and run the business, they can't be classified as 5 or 6 employees who are completely employee driven only. So you have to have additional separate employees. Very important part of the conversation when we are consulting with businesses is to find out if any of the employees that they mention to us are related. So they don't need to be directors or shareholders. They could actually physically be related to the board members. And so we do a bit of due diligence, a bit of checking. But if the situation is correct, this couple can sell 100% of their business for £18 million and pay not 1 penny in capital gains tax, because the trust has been established under the Inland Revenue's own rules and guidance on employee ownership. In fact, it's something which is welcomed in the industry, because employees owning companies certainly helps the business in terms of how it drives itself forward. Classic example is John Lewis. But of course the same question comes up in terms of tax and the payments owing. Obviously from a tax perspective there is no tax, so the EOT, the trust, receives money by way of dividends from the shares, and in year 1, if that dividend was the same £100,000, it is paid out in full to the shareholders because it qualifies for the money to be paid without any tax. In year 2 there's another 100,000 which is paid out, again without any tax. And in year 3, again, no tax, and in year 4, and in year 5 to 10, and so on and so forth. So the next question is, what happens if you sell the business for more than the 18 million? Let's imagine that it was sold for 19 million just 2 years later. The general principle is this: if the business were genuinely sold in the future for a figure slightly bigger than the amount that they sold it to the employee trust, the shares go and we end up with cash. And in this particular case, the apportionment of the cash is a very large chunk is owed to the 2 individuals tax-free. In this particular example, 8.9 million each without any tax to pay. So this couple have sold the business and not paid any tax whatsoever. The little bit that remains, the 1.2 million that remains, will remain in the trust, and that's normally used to pay benefits to employees. And with this special type of trust, employees are entitled to an annual bonus of £3,600 tax-free. There's a whole range of rules and regulations about what happens to the money, but at the end of the day we have a couple who've managed to sell their business for £18 million and pay no tax at all, and they've only lost out on that additional £1 million. And by losing out, I mean that is retained and goes to the employees. Now, If I were running a business and I had lots of employees building the business for me and helping me, and I was to sell it for £19 million, I would absolutely not begrudge giving £1 million and spreading that around the employees, because without them I wouldn't have a business worth 19 million. So most entrepreneurs that we meet and talk to are very happy with this situation. It's just down to timing. And there's a whole raft of questions to be asked in terms of what's going to work best for everybody. It's not just about the mother and the father, it's about the son and the daughter and the next generation. It's also about planning ahead, and sometimes you've got to catch the company at just the right situation. So there we go. That's a quick run through of some of the things that we can get involved in with regards to businesses where we have shares that can be moved around and or sold.